everybody, welcome to a new video update for Monday, the 23rd of September. My name is Julius de Kempenaer and I'm presenting from Amsterdam in the Netherlands. First of all, apologies for missing a beat last week. I caught something that, as I wrote somewhere, it looked like COVID, it felt like COVID, but it did not identify as COVID. But still, it was a crappy feeling. On demand, good enough to do another video for you guys. So let's kick it off right away and take a look at what the markets are throwing at us. Starting with the RRG for asset classes. I'm going to blow this up a little bit here. As you can see, Bitcoin is still a bit of a distorting factor. This is the weekly RRG, and you can see how big that move to the downside has been. And over the last 2 weeks, it's been picking up very sharply, very rapidly on the RS momentum scale, but not yet on the relative strength scale. So the JDK RS ratio, which is the relative strength metric that will eventually push, hopefully, Bitcoin to the right. From this perspective, it's the weakest asset class. If we change this to a daily, it's completely different. But in the longer term trend, Bitcoin is just about to pick up some relative momentum. So we have to wait and see whether that continues in this universe and in this time frame. For now, I'm going to tick it off because it distorts my chart. And I'm going to fit it again. And what you see here is that the commodity ETFs, which is DJP and GSG, they're way down in the lagging quadrant, indicating the relative underperformance, the relative downtrend for these commodity ETFs vis-a-vis VBINX, which is the 60-40% benchmark that we use as the benchmark, the metric, the yardstick for this universe of asset classes. Let me take these off as well so I get a better visualization, a better grip on what's going on in the, let me say, major asset classes, stocks and bonds, because that is probably one of the most important decisions that investors have to make. And here we have the weekly RRG for stocks, which is SPY, and we've got three asset classes in the fixed income space. So it's high yield, government bonds, and corporate bonds. You can see how the direction is in favor of the fixed income asset classes. They're moving from left to right, where SPY is moving from right to left. SPY is losing on the RS ratio scale, while the others are picking up. In general, that means a preference for those fixed income asset classes. That's on the weekly time frame. That's the larger trends. Now, if we switch this to a daily RRG, and here you see a completely different picture when you compare stocks versus the fixed income asset classes. SPY has turned around, and this is updated until last Friday. And you can see how, not even the entire week, only like 1, 2, 3 days, you see that swift turn in stocks and the opposite turn in the fixed income stuff. And it's obviously after the Fed decision to cut rates by 0.5 percentage point. So that is the result of people jumping on the bandwagon after that decision. Our job is to investigate and to decide whether that is a strong enough move and whether it has any lags to run, whether it's strong enough to actually start a new trend or a trend continuation, if you wish. The interesting thing is that if you zoom in here, and I'm going to just do stocks versus government bonds. We're going to take high yield and corporate bonds off and just do SPY versus GOVT, and you can see that they're like at crossroads. They're right in the middle of the chart. What's also interesting is that they're right in the middle of the chart. So it means that they are like, this is the benchmark right now. On both sides, it is the benchmark. So this chart doesn't really, apart from the opposite movements, it doesn't give you a real clue of where you're going. I do think that that weekly chart gives a little bit more of that information. And again, I'm just going to do GOVT and SPY And if I look at this chart, the main trend is for stocks to move towards lagging, and bonds, government bonds, it's a little bit weaselly. They both have stable momentum values, but they're moving in opposite directions in favor of government bonds. Makes it quite a difficult market at the moment, quite a difficult decision to make. But I just wanted to share this with you. And when we bring that to a regular chart, and let's start with, why not? Let's start with SPY. The breakout is there, that is 100% clear, but look at the relative. The relative is inside that rising channel, but the last low is lower. It's in a more sideways, so the last low is lower, but the last low is higher, which makes it like, it looks like starting to form a triangle. If you look at the RRG lines, these are pointing clearly lower, and that's what's making that tail move towards the lagging quadrant. Now, if we bring up the same chart for GOVT, it's kind of the opposite. You can see how GOVT is pushing against overhead resistance. It's in the 2360 type area, so that's this reading right here. And you can see how the RRG lines are picking up, and that's why GOVT is inside the improving quadrant, heading towards leading, and the momentum values are kind of flat over the last couple of weeks. From this perspective, I think that the message is that there is still a preference for bonds, albeit minimal, not super convincing, and that has all to do with the chart on how the SPY chart itself looks, and also what's happening in sectors, and I'm going to address that in the next segment. Let's take this approach. Let me quickly go over all the weekly charts of all the sectors, take a little look, do a little assessment of what's going on, and then see if we can wrap that up into a conclusion or a scenario for the S&P 500, for the market in general. So let's start with materials, XLB. So it'll be in alphabetical order based on the ticker symbol. So materials, clearly the chart is breaking out to the upside, just like the S&P 500, kind of a different structure, but the breakout is clearly there. And so far this week, this is only Monday, this is only today's trading, we're holding up. If you look at the relative strength versus the S&P 500, it's still under pressure. We're inside the improving quadrant, relatively low RS ratio, but it's picking up, so we're moving towards leading. So materials is improving, let's put it like that. If we go to communication services, we can see how this uptrend is still there, and we just broke out to the upside, new all-time highs, and within the channel, still some room to maneuver to the upside, actually flipping the risk reward for this sector into positive territory. The only thing that we still need to establish is new relative strength, because as you can see here, relative strength is in line with the market. This RS line is moving almost sideways, and that means that it is moving in line with the market, and that reflects here in the RRG lines of two lines that are moving almost horizontally around the 100 level. So there's not much to gain, there's also not much to lose in terms of relative strength versus SPY. The energy sector, bouncing on this support zone. It's a rising support zone. We have tested it a few times over the last couple of weeks. We just bounced off, but the downtrend here is still there. If you look at the relative strength, we broke below the previous low. So this rhythm of lower highs and lower lows is still there. Now I know that there's been some very nice returns over the last couple of weeks, but the question is whether that is sustainable. And if I look at the trend channel that's playing out here in this XLRE chart, that's still lower until we're breaking this series of lower highs and lower lows. In combination with this series of lower highs and lower lows in terms of relative strength, this is one of the weaker sectors. Nevertheless, the price gains that we've seen over the last week or two. Here you see how RS ratio is still at a relatively low level, while RS momentum is around 100. A very possible scenario is that we will see more relative weakness and that RS momentum will peak against or just below 100, and it will continue to push RS ratio lower, making energy one of the weaker sectors at the moment. Here is financials. Financials broke out to new highs already a couple of weeks ago. We then tested the former breakout level as support, which held, which is good. And we're now testing the new high, and so far we haven't been able to break through. So last week's high was in the neighborhood there, and today there's not really a follow through, and as a result, the relative strength of the financial sector remains inside this sideways move. We still need, or would like, to see the breakout to the upside for financials to actually improve and get some form of a leader's role. In terms of the RRG lines, it's inside the leading quadrant, so that is picking up this trend. You can see how it's this week, last 2 weeks, it's starting to roll over. So in order for this XLF sector, financial sector, to really push further into the leading quadrant, I think we would need to see a break of raw relative strength out of this range. That would really make the financial sector one of the leading sectors inside the S&P 500. We're not there yet, possibly when it breaks. Industrials, again, breaking to new highs, one of the better sectors. You can see how raw relative strength is starting to pick up, and we're breaking above previous highs, so that's a good thing. And the RRG lines have picked up. It's almost pushing into the leading quadrant. So industrials, one of the better sectors, I would say. And then technology. The problem is that this is the biggest sector in the universe. It's about 30% of the market. So everything technology does has a big impact on the market as a whole. And what you can see here is that we're inside that rising channel still, with that one move intra-week out of that channel. We tested the lower boundary, which is good, it held. But we're now at one lower high, and we've got to wait and see whether we can take out last week's. Last week's high was just below that previous high. Today, not a lot has happened inside the technology sector. But what you can also see is that relative strength is not picking up, and the RRG lines are clearly pointing lower. The momentum, because of the slowdown last week, momentum has now just put in a little blick up. But it's from a relative perspective, it's still, one of the weakest, if not the weakest sector in the universe. And obviously that's a major problem for the market as a whole. If 30% of the market is under pressure from a relative perspective, that is not very helpful for a full-fledged bull market. And then we've got consumer staples, and I'm gonna revert back to this chart at the end of reviewing all the sectors, because this is one of the more interesting ones. Here is real estate. That break is very clearly visible. You can also see the break from relative strength perspective, and the RRG lines have already established themselves way into the leading quadrant, making real estate one of the stronger sectors. No doubt it has to do with the interest rate decision and the lowering of the rates, improvement in bonds and fixed income markets. That obviously has a positive effect on real estate stocks, as also on the financial stocks, although they have not made that break that we've seen in the real estate sector. Here is utilities, also breaking out to new highs. This previous high was dating back to 2022. We've now cleared that overhead resistance, and you can see how relative strength is coming out of that base, out of that decline, and the RRG lines have already picked up. Utilities have rotated from leading into weakening, and they're now rotating back, or have rotated back into the leading quadrant, making utilities one of the stronger, if not the strongest sector in the universe right now. And now we're not wrapping it up, one more. This is healthcare. Also a pretty strong price chart. Trying to get out of the downtrend from a relative strength perspective, but having trouble with overhead resistance from previous lows. And you can see how the RRG lines have picked up, and you can see how a little loss of momentum is taking place this week, so only today. And we have to wait and see how that plays out in coming weeks. But I would love to see healthcare to take out this resistance area in terms of relative strength. And while it remains above this rising support line, that would be a really good sign for the healthcare sector. And then finally, we have consumer discretionary, another one of the major sectors inside the S&P 500 in terms of market capitalization. You can see how consumer discretionary is still not at the level of the all-time high. That dates back to late 2021. We did break overhead resistance, and it looks as if we're bottoming out in terms of relative strength. The RRG line still needs some work. It's positioning consumer discretionary inside the improving quadrant, moving towards leading. So that is a good thing. Now, what does that mean for the S&P 500? Let's see if we can bring all of this together. We saw the asset class rotation and how the weekly trends pretty much still favor fixed income because stocks are moving towards lagging and fixed income is moving towards leading. Their trends are moving in opposite directions. If we go over all the individual sectors, we've seen that quite a few sectors are breaking to new highs. And so far this week, because the breaks are generally happening last week, and this week's only one day of trading, but so far they're holding up reasonably well. There's one big problem, and that's the technology sector. Maybe a few others, but technology is the 30% elephant in the room, which is not doing well. And it is keeping the market under pressure. It's holding it back from unleashing its upward potential. Because if you look at the chart of the S&P 500, and we'll do that in a minute, you can see the break. But when it's a good break, you will see an acceleration. You will see that. I always compare that with a spring that's been put under pressure for quite some time, and then all of a sudden you release that spring and you got a lot of energy that explodes, and that usually pushes a market higher. That's when you have tested resistance, a bit of a vacuum builds up behind that resistance because it's selling pressure, selling pressure, selling pressure. And then when all that supply is gone and there is still demand, you blast through that vacuum of a lack of supply. That's not happening in the S&P 500. We broke, but we're not accelerating higher. And in combination with the sector rotation analysis that I just gave you, that led me to write my latest blog article because I did feel crap and I had no voice, but I could still look at charts and do a little bit of writing. And I think that, and it took me a little bit of time to come up with this title, but I think it's really a dilemma because you've heard me talk about defensive rotation and being cautious, etc., etc. And now I'll be the first to admit that price pays. So the break of the S&P 500 upward is a positive thing. It's undeniable. But going over some of the additional inputs from sector rotation and also looking at some of the classic technical indicators on the S&P chart, I'm not super convinced yet. And let me show you why. Because when you look at the, and I can do that here on the RRG. If you look at the rotation, so what I did is I actually, because this whole setup reminds me of the end of 2021 moving into 2022. So if we move the cursor back to 2021, 2022, that's where that major peak in the S&P before that decline that we saw in 2022 started to occur. We saw, during the rally, we saw defensive sectors picking up relative strength. And during the formation of that peak, that's where we are right here. So this is the period ending January 3rd. you can see how these sectors are moving into that leading quadrant. They're pushing higher at strong RRG headings. That's leadership from defensive sectors, and it's happening around a peak. Mind you, at that time, the S&P was breaking to new highs. It was taking out its previous high. And I remember very well that it was confusing for me at the time. And after a while, you can see how they roll over, and then you can see how the market declines, and all these sectors remain on the right-hand side. But that's old news. If we fast forward to the current day and age, you can see here how, and this is July, so here's the date. July, you rotate higher and you can see the improvement for those defensive sectors going into the current situation. And obviously they're not exactly at the same location, but the behavior of those tails is very, very similar. They're at strong RRG headings and they're inside improving and moving towards leading or already in there. And if we push that forward, this is September 9, 16, and then this is only 1 week. So this is the end of last week. We're still at that positive heading, and today this is only 1 day. So I'm a little bit reluctant to already call these rollovers in terms of relative strength because we still have 4 days of trading to go. But in any event, those sectors are now inside the leading quadrant and they're leading the market, while the S&P is taking out previous resistance. And that is something that's on my radar, and I can't get it out of my head as being a warning signal. This is not the constellation of defensive sectors when you're in a full bull market or starting a new bull market. Maybe it will be the first time in history, but I have a hard time ignoring it. That's probably the best way to say it. Now, the second thing that caught my eye is, and it's especially in the consumer staples sector. If you look at the consumer staples sector, at the end of 2021, it was breaking out to new highs, it was rallying. And this is the S&P 500. We're breaking to new highs and not really got the follow through as you saw it in the consumer staples sector. And here is the current situation. S&P is breaking, but not really following through. And you already saw the break in the staples sector, and it's continuing higher and it's now stalling against resistance. But also look at the move in the raw strength line. So here now is the S&P 500, and this is a relative strength versus of the staples sector versus the S&P 500. And here you can see how in this run up, we break out of a relative downtrend in the staples sector and started to move higher. The same thing is happening here. And if you look at the situation in the RRG lines, it's very, very similar. You can see how the improvement was getting there. It accelerated when we broke out of that falling trend in relative strength. And you can see the same situation right here. I cannot unsee this as being a warning signal or something that I have to pay attention to. And then finally, when I bring in just very classical technical indicators like the MACD and the RSI, and especially divergences, and I compare what's happened in 2021, or late 2021 going into 2022, and today, you can see how the RSI started diverging. It's not really diverging, this is a horizontal, it's divergence, but not the strongest that you can get. But for a period, we moved sideways in the RSI while the market moved higher. And then we had a little dip. And then just on this last break, you can see a pretty strong negative divergence. Now here you can see how these peaks in the RSI are at the same level while the market's moving higher. And in the last segment here, you can see how we have this buildup of a strong negative divergence. And despite the rally today, it is still there. Again, it's only 1 day, but it's not pushing above that negative divergence. And then finally, the divergence in the MACD, which is takes longer to build up. It is usually a little bit more, has a bigger impact. If you look at that situation back in 2021, almost the entire year of 2021, that MACD was kind of diverging negatively until it started to accelerate lower when the peak was in place. And what you see here is that we now have, it's not a year yet, but it's a decent amount of months that RSI, that MACD is showing a strong negative divergence. And it's not at its lowest level. You know, buying opportunities or buying situations in those MACDs arise when you're bottoming out at a low level or maybe around 100. But look at this one here. This is a real bottom situation. I should have actually penciled in that positive divergence, which happened at the end of the downtrend. Now, again, the title for the blog article wasn't entirely coincidental. I think it's a real big dilemma because I can make an argument for a bullish scenario as easily as I can make an argument for a bearish scenario. So it's really up in the air, but from what I see now and what I just showed you, the staples analogy, the divergences analogy, the rotational analogy, especially for the defensive sectors, I am not 100% convinced that this break in the S&P 500 is the start and the ignition for a continuation of the long-term bull market that we are still in. But given the situation that we have, the weakness that's still visible in technology and the impact it has on the market as a whole, it's a dilemma. And I'm going to stay on the sideline and be very, very cautious for at least the remainder of this week, and then we'll assess it again and see what happens. You know, this market will resolve itself either way, or these divergences will get broken to the upside when the market continues to rally, and then everything's back in sync and we'll have a bull market or a continuation of the bull market, or the market will turn around, put in a higher high with a lower high in the MACD and the RSI, and the divergence will play out and we will get the decline, which is supported by a rotation to defensives. I hope to be able to give you a little bit more information and get a clearer picture next week. And I love to see you there. Same time, same place.